Well, Warner Brothers Discovery shares are falling after the company missed on the top and bottom line. The company also missing expectations on total subscribers for the fourth quarter. For a deeper dive into the company's earnings report, we're joined by Ken Leon, CFRA Research Director of Equity Research. Ken, great to have you here with us this afternoon for a time such as this to discuss where things went wrong for Warner Brothers Discovery. What jumped out to you?
So, unlike some of its competitors that were able to hold the line on advertising revenue, Warner Brothers Discovery had very weak decline in advertising revenue for the traditional network business, down 14%. That's a major disappointment, by far their largest business, and it also affected their earnings and cash flow. With that, it's hard really to kind of course correct with their streaming business. And they've been going back and forth with whether to combine Discovery Plus with HBO Max, and it looks like they will not. Additionally, the film business, unlike Paramount, didn't have a blockbuster movie. So you put that all together, you had slight miss on revenue and also adjusted EBITDA. And I think the whole notion that in their traditional broadcast business or networks that they get advertising revenue from general entertainment, which Bob Iger in Disney is probably backing away from, is a question mark. For Paramount, it was actually pretty good. But for today, for Warner Brothers Discovery, it's really hard to find where there are positives other than they generated free cash flow. And I think on the earnings call, everyone will be looking to whether there's any change of guidance for 2023.
And specifically on that, what are you going to be looking for on the earnings call? You're talking about guidance. Will you be looking also at what the company talks about as far as prices for streaming is concerned?
So besides the operating business, we're talking about a company with significant debt that it still needs to pay down. And they've been doing that, but the likelihood is that there might be a recognition that they may have to sell some assets. That's, I think, one area is where are they going to find a source of funds? Second is really, can they still hold the line with their end of 2023 EBITDA target, which is well over $3 billion, which I think they can. They're doing a restructuring, plus they're also fighting a weaker advertising market, and they're also trying to figure out their business model for direct-to-consumer streaming. And you put that all together against some very tough competitors. You have to wonder, why did the stock go from 9.5 up to over almost 16 since January? And certainly the correction we're seeing so far aftermarket is not that much.
Who wins the head-to-head in a Warner Brothers Discovery bundle versus a Disney bundle?
So I think they really offer very different types of content, in some cases for different audiences. Disney, of course, it's much more family-oriented. Discovery Plus is really best in class on non-scripted reality type programs. HBO is really their strong franchise. There was some talk that they would, in that streaming offering, instead of HBO Max, change it to Max. That would be a mistake. And we saw with Paramount, where they are combining Showtime with Paramount Plus. So why not combine the pay TV network for HBO with their streaming business, HBO Max? So those are questions I think will be asked by the analysts on the call. And at the end of the day, this management, it's a very good management, but they have a lot of important areas that they have to tackle in a very competitive market.
But have they missed the boat?
I don't think so. I'm not sure they've missed the boat. You have to leverage your franchises. Nobody, is going to catch Netflix on making, streaming, video streaming, your primary business. They're all trying to orchestrate what is your portfolio of content, where can you do best on distribution, and if you have a large base in linear networks, particularly pay TV, How can you continue to at least get that as, stable growth with cash flow and figure out streaming? So I don't think they've missed the boat, but when you do the size of that acquisition that they did from AT&T, on top of that, it puts more pressure because you're also changing culture.
Ken, you talked earlier about restructuring, and CNN has had layoffs, it's had organizational changes, it's had some controversies regarding its morning show. So how does a company sort of navigate the challenges when it comes to its property, CNN?
It's a great property, and it's just hard, for the company, but particularly for an investor to say, how significant it is to the total overall business for this company. If we were talking Fox, it would be enormous. Obviously, with Fox News, Fox Sports, live events, they're number one. In the case of Warner Brothers Discovery, it's kind of a great franchise. They are making changes. They got new leadership there, and it's going to be less one-sided, whatever their view is, and be more objective news. But in terms of its contribution to revenue, it's not that significant.
Ken Leon, thank you so much for joining us.